Welcome to the Daily Insights that Matter. Amid the continuing correction of the global technology market, US-based investment firm Invesco has slashed Swiggy's valuation by almost 50% to $5.5 billion. Invesco had valued Swiggy at $10.7 billion in January 2022, when it had invested $700 million in its funding round, which gave Swiggy the decacorn status. However, Invesco revised its valuation on October 31st, 2022 to $8.2 billion amid the correction of the technology market. In a recent bid of valuation, Invesco has now again slashed its valuation the second time to $5.5 billion from $8.2 billion, cutting the valuation by almost 33.3%. Invesco states that the performance of market participants is one of the factors it considers when determining the valuation of its portfolio startups. Swiggy has been on a wild ride as it laid off 380 employees from its 6,000 workforce, citing challenging macroeconomic conditions and a slowdown in the growth of its food delivery business. Apart from restructuring its workforce, it also shut down unprofitable products to improve its cost rationalization. The valuation cuts come amid the ongoing funding winter that has made fundraising difficult for startups and macroeconomic uncertainties that are weighing heavily on technology firms. This has led to a lot of tech companies laying off employees and cutting costs to manage operations and steep losses. The Indian startups had a phase where money had been pouring, resulting into high valuations sometimes in the absence of a solid business model. Several other unicorns have faced markdowns by their key investors like Byju's, Oyo, Snapdeal, Quicker, etc. as investors adjust their valuations and estimates in the face of a weakening global economy. Fitch Ratings, one of the world's top credit rating agencies, recently affirmed India's credit rating at a BBB- with a stable outlook. Let's talk about this. Before we talk about that, let's understand what a sovereign rating means. A country's credit rating is a reflection of its credit worthiness, which indicates the government's ability to repay its debt without default. This rating is critical because it gives investors insights into the level of risk associated with investing in a country's particular debt instruments like bonds. There are three main rating agencies: Moody's, Standard & Poor's, and Fitch, and the credit rating scale comparison looks something like this. Coming to Fitch, India's credit rating is at a BBB- with a stable outlook. India's rating reflects strength from a robust growth outlook compared to its peers and resilient external finances, which have helped it navigate large external shocks over the past year. Moreover, Fitch Ratings predict that India will be one of the fastest growing sovereigns globally in the coming years, with a growth rate of 6% in fiscal year 24 and 6.7% by fiscal year 25. It said the growth will be supported by resilient investment prospects, but highlighted that the country's growth faces challenges due to elevated levels of inflation, high interest rates, and subdued global demand, along with fading pandemic-induced pent-up demand. As a developing country, India relies heavily on foreign portfolio investment inflows into equity and debt instruments. Any change in the country's credit rating can impact the FPI flow, which can have consequences for the economy. However, Fitch Ratings' assessment of India's growth prospects has been positive. So what does all of these news mean for you? The devaluation is a part of the continuing correction of the global technology markets. With the ongoing macroeconomic uncertainties and recent banking system failures, Indian startups have faced difficulties. This will have an indirect negative impact on you. Fitch Ratings' affirmation of India's rating with a stable outlook is a positive development for the country's economy, which is poised for strong growth in the coming years. This will have an indirect positive impact on you. While I say this is me, Rahul Hassan, signing off. Have a great day and stay safe.
Did you like watching this video? Then download our app, Informed Investor, to watch more such informative and interesting videos.